when actually it's a self-inflated return. And when the halo of all that money coming in fades away, and what you have is the fundamentals of the assets that are owned, as the old saying goes, shoopy doop, hoopy scoop.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Hey, you.
Hello, Doogles.
Hey, you. How you doing?
Get the joke done already. Get the joke over with.
No, I'm not. The punchline won't hit until 36 minutes in.
Okay, perfect. Sorry to miss last week. I was up in Canada, man.
Yes. Which means we got to come with the thunder.
How many text messages did I send you this week? 7,000?
At least 98. At least 98 minimum. It was so many.
This is a moment in time, Doogles. Take this podcast episode, and it's going to be evergreen content. What happened in the past 3 weeks and what has happened in 2024 is like just something that will be remembered for a long period of time. There are too many indicators flashing, not red, but flashing, this is unique, this is unusual, that we're not going to make predictions about what happens when, but we're going to tell you how unique some of the things that are happening right now are. And I think it's utterly fascinating.
Kick us off.
We're going to talk a lot about Nvidia today, a lot about Broadcom, a lot about
Nvidia
market concentration. We're also going to talk about the stock market being at or around all-time highs. And so first thing I want to talk about is Ned Davis research with a graph on household stock allocation at an all-time high. The way they do this is actual as a percentage of total financial assets. So it makes sense in terms of if the stock market's near all-time highs, this number's probably near all-time highs. But we're talking right now, Doogles, back in 2001, like .com crash, this number was at about 31%. And we're approaching 35%. 35% of all wealth is in equities right now.
What do you think? This is getting personal for a second. What is your percentage, roughly?
I don't know. If you know that number for you, hold on. Let me look at a spreadsheet.
I know directionally. I don't know exactly, but I think it's probably about half in my world.
Yeah, in my world. You didn't think I was actually going to run the numbers, did you?
No, I didn't.
It's more than half for me, maybe 60%.
Yeah, that's one thing that's interesting. We'll get back to the chart that you're talking about, but one thing that's interesting to me is a third for me. I can't picture my life getting to a point where like a third feels low.
Well, so hold on. The quick calculation I just did does include like my bond holdings and some money market like cash like positions. I kind of did what's in brokerage accounts, so maybe I'm actually less, but Doogles, you and I are not the subset here that really matters. This is talking about your average American.
Yeah, no, I agree. It was only striking to me. The reason I raised that is because all-time highs for the general America would be like all-time lows for not all-time lows, but like it's kind of a fascinating to me.
No, honestly though, I think that's worth pointing out. We both believe, correct me if I say anything wrong here, we both believe that investing in equities, and usually U.S. equities, is the best path to wealth. It fits our psyche. We believe it's better than real estate investing or debt investing or crypto speculation, et cetera, right?
Yeah.
So we should be outliers here, because your average American that manages to spend less than they make typically can get more comfortable with real estate or other asset classes, because you have to do a lot of research to get comfortable with investing in equities, especially individual equities.
Yeah, I think that's right. That's right. It makes sense.
Okay. All right. So that's kind of step one on this path we're on today. Step two is so much about Nvidia. And apologies, but the only way I think that to do this is to dive into a really long tweet from Christopher Bloomstrand, who's a really knowledgeable investor, started at Fidelity, if I remember correctly. and is an expert in all things Berkshire, but also knows a lot about Costco and is a good market historian here. Do you have this tweet up?
No, I do not.
Okay,
I'm trying to get it though.
find it. Before we talk NVIDIA, I actually want to talk about Costco. For those who don't know, Costco is a legendary company that was loved by Charlie Munger. And because of that, it almost has this cult following, not only with the shopping experience, but with the investing experience. I hadn't looked at Costco in years, Doogles, right? It's not something that's ever really piqued my interest. Let's talk about the extremes of Costco's valuation today. Costco has $186 billion market cap on 254 billion in sales. So you're like, hey, that sounds pretty good. A
Yeah, it's
quarter
not
of
bad.
$1 trillion in sales. Amazing. This would, if you go with like a price to sales metric, right? Let's call it 400 million on 250 in sales. It's crazy, but it doesn't seem that extreme in a world where you hear about Nvidia or Microsoft all the time, right? Here's the thing. Costco's profit margin, Costco's basically a grocery store. It's not building semiconductors or selling artificial intelligence. It doesn't have 50% profit margins. It's not Visa.
Yeah.
Costco's profit margin is 2.8%, which is up from a more typical profit margin of 1.7%. How on earth can you justify basically a $400 billion market cap on something that has a 2% profit margin and is only doing 250 billion in sales? This stock currently has a PE multiple of 54.
5.4?
No, 54. Here's the stat to hopefully make it real. So if you take the stats today and enable 2.5% growth in system-wide square footage, double same-store sales, and have modest potential growth to increase margins, in 8 years, the stock would trade at 25 times earnings.
In only 8 years.
In only 8 years. The
What do you think
just,
this is a sign of? What do you think this is a sign of? You think it's just the halo that you mentioned from Munger?
to not dance around things, bubble. I mean, this is Costco's a great company. Costco should never trade at 54 times PE, in my opinion. It just doesn't make sense. It's a super low margin retail warehouse. Why is
And
that worth 54 times?
to say more, this gets to your point around it's not in semiconductors, it's not et cetera, et cetera. I think what you're saying is there's this story that if you take something like Nvidia, which we'll talk about, there's a story, whether you believe it or not, that you could say they're going to keep crushing AI. The AI demand is going to grow by order of magnitude. So therefore, there's some universe in which you could see Nvidia growing into its valuation. Not saying one could.
Yeah.
With Costco, what is the story that gets them to increase earnings by 30x, right? So that they can, or whatever it ends up being. Is that basically what you're saying?
Yeah. I mean, so at a 2-ish% profit margin, seriously, if you're a Costco investor, do the math. Like, what happens if they sell $3 trillion a year? And then start doing a valuation on that. And then it roughly explain to me how they're going to sell $3 trillion worth of goods a year, because I don't think there's a ton of expansion prospects. I mean, I know it's well loved in Asia with the little footprint it has. I don't know the stock well. I just think 54 times PE is
It's a lot.
crazy.
It's a heck of a lot. You have to probably believe international is the only story I can think of, or somehow their gold sales go through the roof.
Right. Okay, so let's just continue the conversation on Nvidia. Let's talk Nvidia and Microsoft as well. So this year, the so-called Magnificent Seven has really been a magnificent one, and maybe Broadcom coming up, which I'm gonna give you a hard time.
Magnificent Eight. Magnificent Eight.
Through May 31st. This is slightly outdated, but you get the point. Nvidia's total return for the year is like 121%, and the contribution to the S&P 500 total return is basically 32%. So 32% of all the return, the positive return, is attributed to one stock, Nvidia. Nvidia is currently trading somewhere around 42 times sales.
Yep.
What that means, Doogles, I know you're sick of me saying this, but what that means is if they stay where they are today for the next 42 years and they manage to have a profit margin of 100%, which we all know is impossible, if I bought their stock today and they returned all that money for the next 42 years and had a 100% profit margin, I could make my return on investment. I could break even 42 years from now. Now, obviously, crazy people like you who are momentum investors, sorry, just messing with you,
Wow.
but think that it's not going to stay where it is today. It's going to grow, and it's going to grow massively, and it's going to grow like it has for the last 6 quarters. My point here is it's currently the most valuable company in the world. It's larger than the GDP of every country in the world except for the top 7. Its market cap is larger than all of the crypto market combined. Its market cap is 5 times the market cap of Tesla. Its market cap of 6 times the market cap of Walmart. Its market cap is bigger than the entire French stock market. It's roughly equivalent to Canada's GDP plus $1.2 trillion in cash. I mean, how is it going to grow into something much bigger than the world's biggest company and a company, world's most valuable, not world's biggest, world's most valuable company, and a company that has effectively tripled in value in a very short period of time? Explain it to me, Douglas.
Animal spirits. That's all I got to say. Animal spirits. Can I break off for a second? You just reminded me of something from this week. What you reminded me of when you were talking about your waiting 42-year point. There's this house in San Francisco. San Francisco real estate is out the wazizi all the time, right? It's so expensive over there. No, not for this house. There is a house in San Francisco that right now costs $488,000. I'm not saying that's the cheapest house, but for San Francisco, that is a bewildering price. So you're probably like, oh, what is this in somebody's laundry room? No. This is a 3-bed, 2-bath house that's in Russian Hill. Nice part of San Francisco.
Looks like a pretty good spot. Yeah.
Oh, very nice. Look at the brick stirs in here. You talking about brick stirs? Here's the catch. It's a tiny catch. Not a big deal. You may not be able to move in until 2053. So the deal here, for anyone that's lived in San Francisco, this will ring some biggity bells because San Francisco's rental policies are very generous toward the renter, generally speaking. So you get a lot of rent controls, etc. The people that live in this home have the ability to continue to renew until 2053. So you could buy this house, but until these people decide that they're moving out, you cannot move into this home. So it's priced such that if you view this as a pure investment, have no interest in living in the house, have no interest in choosing who lives in the house, $488,000. Fascinating.
You know what I'd like to do if I had Buffett money and I still hosted a podcast for some reason?
Buy this house?
I think I'd buy this house and I'd buy equal amount of Nvidia stock.
And then wait 42
and I'd
years.
set my timer for 2053. And I'd see who's better off.
Both of them are waiting games. I think you should do it. Even without Buffett money, just do it.
I might buy this house and then, like drop some snakes from the ceiling and, and get the renters to leave on their own. Like, isn't that they'd be willfully leaving.
Oh, I love it. Drop snakes in the ceiling. I love it. All right, back to Nvidia.
So yeah, I mean, you seem unconcerned with my latest rant about how expensive things are. Just level with me here. What do you think?
Concerned would be strong, but it's aggressive. It's very aggressive. This is a topic that off and on we've been talking about for a couple years now. Am I correct?
Absolutely. And when Nvidia's stock, the stock is since split, but when it was at 450, I was ranting about how crazy the valuations were then, and it's currently at the equivalent of like 1300 because it's split and it's at 130 something. So it has proven to be incredibly resilient during this short period of time. Will it be that way in 5 years? Again, we don't make predictions on the show. I think it's highly unlikely. Another reason why this is uphill sledding for them is their net profit margin is above 50%. It's great for them today. It means everyone on earth wants a slice of that pie,
Yes.
right?
You can charge what you want.
And you absolutely can. It's a great business. Should not be valued at 42 times sales. Microsoft, an incredible business with diverse revenue streams that, I sent you a text this week. All the headlines going around when Nvidia passed Microsoft to become the most valuable company, everyone paired it with in 2000 when Cisco passed Microsoft to become the most valuable company. The most amazing thing about those headlines is Microsoft. It's not Nvidia or Cisco, in my opinion. It's that
Yeah.
24 years apart, you still have this incredibly dominant, amazing company. But it's at even Microsoft is at 14 times sales. So all Microsoft has to do for 14 years is have 100% profit margins and return all their money to stakeholders. Like, it's a great company. I don't think it's worth anywhere near 14 times sales.
I don't know what else to I don't know what else to tell you. I don't know what else to tell you. So here's what I'm going to do. Instead of telling
Okay.
you things, I'm going to have my friends over at Global Financial Data say a couple things to you.
You're so over this. Before we get off into the NVIDIA trade, here's another challenge. If you joined NVIDIA 5 years ago as a mid-level product manager with an annual 70K stock grant over 40 years, your initial grant would be worth about $11 million.
Here's okay. You can, how somebody you can hold like a little knife in somebody and you just keep twisting that blade.
Yeah.
Here's what you're doing to me when you say things like that, when you say words like that. What if 5 years ago, Nvidia was 25% of your stock portfolio?
I wasn't going to go there,
And and
Doogles.
and what if 2 years ago you sold Nvidia?
Do you want to have a therapy session? No, actually, okay, sorry. This was not on the scheduled programming. This makes me so proud of you, although I hope that doesn't come across the right way. There I told you there's no like extremely logical case to hold Nvidia at 42 times sales. So it sucks for you because you watched the market of hyenas go crazy for one stock in the most bubbly-ish fashion since
Yeah.
1999. But I think that makes you an investor rather than a speculator. I think that shows your process actually has teeth. I think that makes you hundreds of thousands to millions more dollars over the next 40 years than it would for to have 2024 be really fun for you. That's just what I think.
Yeah.
I could be wrong.
No, I think that's accurate. What's so tough about things like this? It's similar even to like the GameStop mania, a few years ago, is when you're not holding a thing, you can see the latest top and be like, oh, if I still held it, not thinking about, oh, I probably would have actually sold this like 6 months ago. I might have sold this a year ago, right? Because there's constant decisions potentially in there when something gets so ridiculously bubbly that it's unlikely, I would say, that I would be holding something when it gets so wild like this, unless my model told me to. Like that's the world in which I live. But let me go to my friends at Global Financial Data.
Okay.
200 years of market concentration. So these folks over at Global Financial Data, this is back in late May, they came out with this. What they did was they looked over a 235-year period. So from 1790, when records were pristine, to present, and looked at what concentration looked like over that period of time. They split the time periods into they split the 235 years into 7 different periods. The first is the Bank of the United States dominates. The second is the rise of the railroads. Third, American Commercial Revolution. Fourth was the first Magnificent Seven. Then free trade leads to global expansion, the rise and fall of the stock market, and then technology stocks take over. So those are the 7 periods from 1790 to present. I'm gonna hit on a couple janks in here. We'll put this on the Substack, skippydoogles.substack.com. We'll put this on the Substack so you can go and read through more. But it's interesting to me to look through the various periods and how long some of the concentration points last. But also it's important to note that we were so concentrated back when the Bank of the United States dominated. There was like 4 stocks that existed. By definition, the stock market had to be concentrated. Just a little FYI there. We're talking about the Bank of the United States, was 85% of the stock market back then.
Yeah.
It's a useless stat because again there were so few, but I find it to be interesting. The rise of the railroads was another like fascinating one. So this is the period back from 1840 to 1875 is where they drew the line. So mid to late 19th century. And the railroads, transportation in general, made up something like 70% of the stock market, like in total, the transportation sector. Very interesting. I'm gonna skip ahead. I'm gonna skip ahead and talk about there's this graph in here where it looks at the top 10 companies by market cap and what percentage they make up. And the lowest ever is around 16%. And the highest is closer to about 45%, roughly. That's roughly where we are right now, according to this. And it's also where we were in like the 50s to 70s period. The 16% point came in the early 1990s and then also in 2014. So the fluctuation is pretty wild when you look at this graph over time. It just goes up and down and up and down. What they took away from this, which is not what I would take away, what they took away from this was because it just fluctuates so much over the last 235 years, it's completely unpredictable and there's nothing to see here. I think it's really hard to compare 1790 to 2024. It's interesting academically and tactically not particularly helpful is what I find, but I do find it to be academically interesting.
I generally agree. I mean, I think if you have a holistic data set that you can trust in 1790, there's a lot of parallels because it all relates to human behavior.
Yep.
I just questioned the data set basically. The similar but more interesting graph I've seen recently is not even top 10 stocks, but top 5.
Mm-hmm.
And looking at the concentration there, I mean, again, the top 3 in terms of Apple, Microsoft, and Nvidia are all 3 trillion plus companies. Like,
it's wild.
I think we were actually doing the show when was it Microsoft became the first $1 trillion company. I mean, it wasn't that long ago, and it was thought of as like this behemoth that how could you ever have a company worth $1 trillion? Now we have 3 of them worth 3 times that. The concentration of the S&P 500 right now is rough, meaning that the top stocks are carrying so much more of the true value. I saw a stat 3 weeks back. It really like the top 15 stocks are as important as the remaining 485, something like that. People often compare the equal weighted S&P 500 to the market cap weighted S&P 500 to see how those march along, and not well currently. And all I'm trying to say with these stats is that your typical company in the S&P 500 is not performing well right now, but the index as a whole is actually performing pretty nicely because of things like Nvidia. So here's the stat on that. Right now, the percentage of S&P 500 stocks that are outperforming the index it's something like 30% of all stocks. The median, if you go back to 1990, is about 50%. That makes sense, right? And
yep.
In good times, like in 2022, almost 60% of the stocks outperformed the index. The last time we had numbers this low were shockingly 1998 and 1999. And I think maybe this is just a therapy session for me, Doogles, because all my stocks are doing diddly squat. And then I get to watch you over there owning Broadcom, my stocks that actually make money, that pay dividends.
Broadcom makes money and pays dividends.
Money. Yeah.
And pays dividends.
But it's been so fascinating. Like I said, I just think it's a moment in time. There's all these unique things happening. I'm not making any predictions about the future. I'm not telling you how long this craziness lasts, if you even believe it's craziness. I just know I own a bunch of quality companies over here, and they're not doing anything. The market is not excited about any of those. It's only excited about Nvidia, occasionally Microsoft, Broadcom the last quarter or two. I mean, it's fascinating.
It's fascinating. It is. It's really fascinating. I don't think the market understand. Like let me actually do this. You talk about the market having unique signals, unique moment in time.
Yeah.
The economy we've already discussed is similar, like different signals in both places. But it's very, I'm going to call it confusing to look out and understand, are we in a good place? Are we in a bad place? Like in sentiment in a lot of cases, like doesn't feel positive, but then there are all these indicators that look positive. Like it is weird. It's a weird moment.
You ask, are we in a good place? I mean, I don't think so. I'm not Mr. Doom and Gloom here, but like if you just use that word unique again, the other times that we've had this sort of uniqueness, it hasn't led to stocks continuing up and to the right for the next decade.
It has not. Absolutely.
Here's some
All
more
right.
stats on the
Well, wait,
Magnificent Seven.
before you do that, before you
Yeah.
do that, can I quiz you on the last Magnificent Seven?
Oh, please. This will be
Okay.
fun.
So the Magnificent Seven, before this Magnificent Seven, was from the 30s to the 50s. During this period, market concentration, according to the piece that I was looking at, was fluctuated somewhere between 25-40%. And these were the dominant stocks during that period. The Magnificent Seven. I want to see how many of the Magnificent Seven from that era, 30s to 50s, you can name.
I'm so excited for this. My favorite company of all time is RCA. It's RCA on the list.
No.
What? Right before
Because
the Great Depression, RCA went from like $1 a share to
yeah,
something
it
crazy.
crushed in the 20s. Crushed in the
Oh,
20s.
I'm a little early. All right. Is like Standard Oil too early too?
Standard Oil, that's one of them.
Okay. 30s to 50s. Am I too early for General Electric?
Nope, that's another one.
Okay. I'm Coca-Cola is not on this list, right? It's
Nope.
just growing. It's
Nope.
not a dominant power yet.
Telecommunications. Think telecommunications.
Well, Ma Bell, obviously. The
Mabel. Yep.
mother of all the bells, right?
Right.
AT&T is
AT&T.
on there.
Yep.
Okay.
AT&T.
I mean, there's not like a telegraph company or anything.
There's the technology company for the first half of the 20th century is on there.
Again, I think I'm too early. This is, well, first of all, let's just get the railroads out of the way.
No railroads.
There's no
you're right.
railroads?
You're right. Let's get those out of the way.
Wow, I'm shocked that there's not like a legacy
Mm.
power from the 80s that was sticking around. The technology company. I mean, this is hilarious because the one that comes to mind is IBM because they're such a dinosaur today. IBM's on that list.
IBM's on the list.
So what I get
so far,
four?
we've got AT&T, IBM, Standard Oil, and General Electric.
30s to 50s.
You're missing a company that has probably my most favorite stock chart of all time. Yes, and I am that guy who has favorite stock charts.
Well, listen, if you were a owner of Nvidia, Nvidia would be your favorite stock chart of all time right now.
This is my favorite for a different reason. It is a perfect upside down V. Think Detroit,
General Motors.
General Motors.
How did I not get General Motors? That's like an obvious one. So that's 5 of the 7. Any hints on the last 2 in terms of industry?
Construction materials for one of them, and then chemicals for the other.
Oh, 3M?
Nope. Good guess though.
3M, I'm too early. 30s to 50s. This is not fit either. But like Johnson & Johnson's not on the list. Or
no.
Okay, what are the last 2?
DuPont and U.S. Steel.
I should have got DuPont. And then U.S. Steel, that's a tricky one because we don't have a steel industry anymore. But of course we did in the 30s.
Japan's trying to buy U.S. Steel.
I think they did. It's still up in the courts?
I don't think it fully went through.
Okay.
But look at all y'all. I know you're probably not of the type like I am where you have favorite stock charts, but GM's stock chart is a thing of beauty, not for shareholders. Let's be clear. But it's one of those like meteoric dominant rises. And then you just see when it turns the upside down V, turns around, you have to go to max. But anyway, check that out. All right. Now you can go to the new Magnificent Seven you were about to touch.
No, I mean, I just feel like for completeness, I mean, this is just the high horse I'm on today. So the Magnificent Seven that we've talked about on the show has officially exceeded 15 trillion in market cap. Those 7 stocks.
That's insane.
The group's combined market cap is 50% of US GDP. That's an apples to oranges comparison, but it gives you some context of the size.
Yep.
In the past 2 months, that those 7 stocks have added 2 trillion in value, and in the past 12 months their market cap has grown by 60% compared to only a 20% gain for the other 493 stocks on the S&P.
Yep. That's why they're magnificent.
It's something.
Yeah,
it really is something.
It is something. Remember Coco Beware,
Not at all.
the wrestler?
No.
Well, I'm just trying to say beware. That's all.
Okay. Let's see what's in your fishbowl before we wrap with our friend Jason Swag and some stats on ARK, which I thought was brilliantly done.
I enjoyed this piece. It's also Wall Street Journal, but I enjoyed this piece by Jessica Chow or Jessica Cho. I think it's Jessica Chow, though. It's called The Money Habits I Learned from My Parents, for Better or Worse. What this does is goes through a few different vignettes of individuals and how they think about money because of what they observed. It's most times it's parents, sometimes it's also like a uncle, which is what you observe, what they observed and how they think about money as a result. The author, Jessica, she says that her first memory, she sat down with her mom. Her mom was at a kitchen table, showed her how to open up a brokerage account. And I don't know exactly what her mom was saying to her, but she said from that 30-minute conversation, what she took away was this is very risky and I will never touch this account.
Yep.
She basically heard that investing in stocks is a risky game. You're probably going to lose your money, etc. I'll just hit on a couple other examples because I think maybe my high level point I want to have here is if you are a parent, be cognizant of what your child sees or does not see from you with regard to money, not even just investing, but money in general. Just be cognizant. So there's this friend of Jessica's parents were small business owners and scrimped and saved, right? What they learned from watching their parents were don't spend, only save, work really, really hard and buy a house. That was their financial education.
Yep.
Seemingly no conversation around money, like no explicit conversation around money, but that's the observation that comes from it. Don't spend, only save, work really, really hard and buy a house.
Just to jump in here, there's a political ad. I don't know who it's for. I don't know which side of the aisle it's on right now that has decided to pick on housing as the issue and has all these platforms around. We have to enable this next generation to buy a home to create, I think they say, generational changing wealth or wealth changing, basically generational wealth.
Yep.
And I'm just going, just because that might have happened to someone in the 70s, you have to be smarter. That you can't just assume that you buy this. And this is relative to the Colorado real estate market. If you're listening elsewhere in the world, it might not be relevant to you. But people tend to take these lessons from 30 to 50 to 70 years ago and just think that it's a cookie cutter template to apply today.
I think it's exactly right. And that can come from, if you think about this on this very topic, if you think about that, if you watched how one's parents, I'm not talking about yours, if you watched how one's parents did quote unquote invest and may have built their wealth, let's say that happens, one's parents may have bought their house in the late 70s, early 80s. You go, oh, yeah, so that's what you do, is buy a house, sit on it for 30, 40 years, and you're good. That may not apply in the most unaffordable housing market we've seen, which is right now.
May not. I mean, also, we talk about this all the time, but this idea that the place you live is an investment is a really bizarre idea that wasn't around 300 years ago. The Austin real estate market is not crashing or anything, but prices are falling because they built lots of housing over the past 5 years. That's a good thing to me. But there's seems to be one article a month written about how horrible it is and how many people are upside down. Well, those people willingly decided to pay the price they paid at the time they paid it. Like, that's kind of how this works.
Yeah. And I'm not hoping for badness here. However, I was visiting my mom, North Carolina. The amount of housing they are building in the town that she lives is mind-blowing to me.
Yeah.
Like, absolutely. I mean, it's everywhere I turned, it looked like there are tens to 100 houses being built, like on any given part of the town.
Mhm.
And in my head, I'm thinking we have interest rates where they are right now, not ridiculously high, but high compared to what they have been recently, and prices are high. So the cost of buying a home is really high. I think about where consumers generally speaking are and all this supply coming on the market, those
Ooh,
prices, get go, interrupt.
I'm gonna push back. What happened? So you have current today's current prices, the most unaffordable in history, effectively. What happens if you double supply? That's good.
If you take general economics, yes. But again, you're playing checkers with one little checker. I'm playing Go over here. Okay. No, I'm joking. No, because your point is right that if you raise supply, then prices should go down. But the thing that I'm thinking about is that the prices that they're setting these homes at, like if people are buying the homes at the prices, because I'm looking at the prices they're setting them at, and they are, if I go back when I visited her about 18 months ago,
Mhm.
the houses that they're putting out there now, the price, when it says like starting at, and they're talking
Yeah.
about a development, those prices are somewhere between 30 to 40% higher than they were 18 months ago.
Oh,
So when I
completely. Yeah.
yeah, so when I think about that, and I think 2 years into the future, I don't know if it's 2 years, but I'm just like sometime into the future, I'm like, I don't know how that ends up sustaining. And so it feels like, at least in this one little microcosm, right, in North Carolina, like it feels like there's going to be some deals sometime in the next few years. That's all.
Absolutely.
All right, should we go to Jason? Wrap it up.
I'm sorry, Doogles, but we're going to talk a little Kathy Wood. Okay.
Oh, shucks.
I I think I'm going to let you introduce this article. I can sum it up in about 2 sentences, but a deeper dive is more fun here.
Okay. So it's called Hot Funds and the Curse of Self-Inflated Returns. The point of the whole article here is he's saying when a fund gets hot, one of the ways that this can happen is when a fund gets hot, for example, what we're going to talk about, ARK Innovation. Fund gets really hot and people go, oh, that fund manager I need to get in with. Then there's a whole bunch of money that comes into the fund. And when you buy an asset, the price goes up. So fund gets hot, bunch of people flood in, price
Mhm.
then goes up. And folks is thinking, oh, I got in there because Kathy Wood, for example, because Kathy Wood is a great money manager. I got in and the price went up. I'm so smart. She's so smart. Let's be smart together.
Mhm.
The self-inflated returns part of this is where he's saying the price can sometimes go up because you bought. So if everyone floods in, the price goes up, and you think you all smart along with Kathy, you guys sipping tea in the park, when actually it's a self-inflated return. And when the halo of all that money coming in fades away, and what you have is the fundamentals of the assets that are owned, as the old saying goes, shoopy doop, poopy scoop.
No one's ever said that. No one ever.
It's
So
been said at least once.
this is the result of a new study from Harvard Business School and some guys at Capital Fund Management in Paris. Okay. Jason says they break down one fund, one unnamed fund in their study about basically self-inflating returns. And Jason says, I'd be willing to bet it's ARK. So he doesn't say it's ARK, but the way Jason works,
Did you
I'm
look
pretty
at that? Did you
confident.
look at the chart? Like what other what other fund could that be?
But I want to give a simple example here, and correct me if I make this too simple or if you don't follow. But Douglas over there starts a company, right? It's a cool little company. It's worth I don't know $1 million, and he holds the large majority. He holds like 90% of the stock, but it manages to go public. There's just a little bit of shares trading out there, and I run a portfolio or an ETF. In this case, it's an ETF for reasons we won't go into here. And I have a little bit of that company. And then I go do a CNBC interview, and everyone goes, oh, like this fund manager really knows what's going on. So they write huge checks to my fund, massive checks. And I need to buy more of the stocks that I currently hold. But if there's not much publicly traded shares available, I have to bid those up to other people that might not want to sell them because it's just a very small company. So that's effectively what happens here. And then because I buy more of Doogles company, and because there's not many shares trading, the value of that company goes up pretty significantly. That company is part of my larger fund, so the net asset value of my fund goes up pretty significantly. That leads more money to come in the door. And it's just like a dog chasing its tail here.
Yep.
Where your company in this example, Douglas, might be trading on the stock market saying that the true value of the company is 10 million bucks. But like you actually, as a 90% old owner, watching your net profit margin and everything, might still know this company is probably worth $1 million. And what's happening is just some shenanigans in the public market because of the amount of shares available.
No, you don't understand my psyche. If it was worth $1 million,
yeah,
and now you're saying it's worth 10 million bucks, and I haven't done anything different, then if I continue to not do anything different, we got 100 million bucks just around the corner.
No, so talk about that from your perspective here, because you might go, this thing's not worth 10 million bucks. I'm gonna sell some shares on the open market, and I'm
Yeah.
gonna right.
Yeah.
And in doing that, would your company still be worth
No, it
10
would not.
million bucks?
It would
No,
not be. No, it would
it's
not be.
still a company worth $1 million that you just sold an additional $3 million worth of shares because you know it wasn't worth that. Took cash off the table. Like, so what happens in a case like this is a self-fulfilling prophecy of a very quick and rapid rise in value, and then almost always a very quick and rapid fall in value. It's fascinating. Jason did such a good job with this one.
Yes, so good. And for ARK Innovation specifically, it went up to $26 billion in assets by mid 2021. It was like what, a couple billion prior to its 2020 rise. That is a huge. That's what you were talking about, the self-fulfilling prophecy. I mean, that is enormous. Now it's closer to 6 billion, according to Jason's article. What I couldn't tell, this next stat I'm going to give, I couldn't tell if this was a CAGR or an average, but regardless, he was saying ARK has lost an average of 27.9% annually over the last 3 years. There's one stock that he mentioned. I don't have the name in front of me. One stock that he mentioned that I don't know if it's in ARK today, but was when it had its 2020 rise, that he said it lost an average of like 99% annually. I don't I don't understand how exactly. I didn't look into it, but I'm like, what the heck does that look and feel like to have that as your average? Not the cumulative, but is that, if that is a CAGR, every year you lose all your value? Again, it's kind of a confusing thing, but
I mean,
anyway,
or in 1 year, yeah.
that's why it
The
average versus
number I'm
CAGR
seeing
on
here
that
is
shirt.
97%
Oh, sorry.
annually.
Okay, sorry.
But yeah, you lose 99.5% in 1 year, and you can over a 3-year period.
Yeah, you probably average out. Yeah, it's a good piece.
It's fascinating because we've talked a bunch about Kathy because she became such a superstar, and in some way, she was just along for the ride with a fund structure that has limitations. But with how actively she trades, so let's take it to a hypothetical and not make it about Kathy. If you're running a fund like this, Douglas, and you used to be $100 million and all of a sudden you're managing $50 billion. If it's an actively managed fund, don't you think it's almost wise, fair to your investors to park some of that cash to the side and try and slowly create to manage this? Because internally at ARK, they had to know that whatever company used to be trading at $100 a share that they're currently bidding on at $700 a share in a 2-month period when none of the core details about that company have changed. Like, they had to know that company wasn't worth $700 a share, right?
I'm sure that there were people there that knew. Kathy, if she thinks anything like she talks, which she might not, she may just be like a marketer out there. But if she thinks like she talks, I don't know that she knows anything. I don't mean like she's an idiot or anything. I don't know that she has like a fundamental grasp on value at all.
Okay, let's talk about it in a different way. This would be very tough on the human psyche. If I manage this ETF and I think that a company like Diageo is a great investment. And I watch the stock price go from 130 to 260 to 500. I'm probably going, Diageo's a bad example because it's a bigger company, but I'm probably going, gosh, I'm a genius over here.
Yeah.
I picked these stocks. These stocks all have gone up by 100%.
Yeah.
I'm an absolute genius. That is an interesting dilemma. If you are disconnected from, oh yeah, and I'm buying 100 million of this, and there's only 120 million out there trading publicly.
I agree with you. And especially when you combine that with the fact that how does one successfully beat the market? It is to be contrarian and right.
Mm-hmm.
If you take that as a philosophy and I'm a genius as a fact, then 27.9% annually over 3 years, who cares? The market's just wrong right now.
Yeah.
And it's going to be wrong right into her pockets because she don't need to be right in order to make buku money.
Oh no, anymore. Yeah, she shouldn't
She's
have
good.
a
She's
financial
good.
worry.
So
Which is the fun part of managing others people's money,
yeah,
taking a percent
there
of
you go.
AUM, right?
There you go.
How'd the therapy session go today for you, Douglas?
You got me riled up. It got me real riled up.
Can we close with Broadcom? Broadcom is, or started the year as your second largest holding, correct?
No, it's largest as of this year. It was second largest last year. It passed Dexcom in Q4, I think, of last year.
And only up 50% this year. Are you currently like putting hundreds in your fireplace just to stay warm over there, or like what's happening?
Pretty much, yeah. We've traded out our paper towels for $100 bills. It's honestly the psychology of it right now is a little bit like stop the count. I was like, can the stock market just close right now? Like I don't because it is Broadcom is an absolutely phenomenal business.
Yes.
Phenomenal business. Hands down. Very well managed, brilliant. It grows at a solid clip, like not anything ridiculous, but a solid clip, pays a good dividend, especially for a growth stock.
Mm-hmm.
Phenomenal business. And also, like, what the heck? Like, where, where is this coming from? I mean, I'm happy it's coming. You know what I mean? Like,
Yes.
I'm good for that. But it doubled. Broadcom doubled last year, and is now up 50% this year. On what basis exactly?
People like semiconductors.
There you go.
I
There you
mean,
go. That's right.
I
That's a
listen,
great.
I
It's a
still own some Qualcomm. It's not the worst thing in the
yeah.
world.
No. Yeah.
Turns out my Intel bet was the only way to lose money in semiconductors, which is pretty impressive. I think I deserve a pat on the back for that.
Yeah.
Broadcom, I mean, price to sales of 17. It's pricey.
Yeah, it's pretty pricey. What's kind of fascinating is so you know how in my model, I will sell a stock if it is like lagged in performance or if it is overperforming. And
Yeah.
Broadcom is closer to the overperform, but it has to outperform the market by a pretty solid clip this year in order for it to it's like close, but it have to outperform the market by a pretty solid clip. The market is Nvidia. So and Nvidia is what's driving Broadcom's stock price. So like I don't
Yeah.
I don't quite understand how that will happen.
That's the thing. So Broadcom is the eighth largest stock in the S&P 500 today, I believe.
Yeah.
Yeah, it's also kind of becoming the market. Like if Nvidia still met your criteria and you were judging it against the market, you'd be like, well, this is worthless. Nvidia's the whole market. Judging the stock against itself.
Yeah,
This
exactly.
is fun, Douglas. And the reason I'm I love that you're willing to talk about it, but your quantitative model, the long trend momentum, is in a way kind of made for times like this. I
Yep.
mean,
Yep.
there's a mania, a bubble, call it whatever you want. Again, we're not predicting the future. We don't really care. We're investing for the long term here. But you're watching the run up of this and making money off of it. When you look at, and I don't know that you know this off the top of your head, but when you look at like the early 2000s, when the momentum reverses, how painful does it get for your model potentially?
It shouldn't be.
Because your top holdings would probably hit the sell trigger. Or
Yeah, if there's likely during that time more turnover that happens of
yep,
stocks.
yep,
And it's there's a difference between typical momentum, which is looking at like a 3 month, 6 month, 12-month period,
mm-hmm.
and the long trend period. The companies that I'm owning are also generally like very solid organizations. The highly concentrated, like when they get concentrated. I also have a
Yeah.
bunch of like weird nonsense that flows through that I get excited about sometimes as well. So we'll see. What does happen though is this happens in general in the stock market, but the volatility likely increases, but I think it should be fine. We'll see. I don't know.
No, here's where I'm going. Broadcom, great company. Super impressive track record. Actually, like price to cash flow 35, current ratio above 1, not tons of debt. Debt to equity is about 1. Like, I'm not arguing that it's a great company. Revenue growth over the past 5 years is like 15%. Free cash flow, profitable, all these things, right? Great. But if it's currently at 17 times sales, and in a non semiconductor crazy world, maybe it should trade at, I don't know, 5 times sales, 8 times sales.
20 times sales.
But it could have a
Yeah.
pretty significant pullback and still be a great company. That's my
No,
whole point.
no. I mean, you're exactly right. If Broadcom got cut in half tomorrow,
Mm-hmm.
it would be like 30% above where it was 18 months ago.
Yeah, totally.
And that you go, okay, like that. And it would still be, if it got cut in half and going to year 17, it'd be at 8.5
Yeah,
for the price to sales. So it'd still be at the point where you're like, it's not cheap,
it
right?
wouldn't
I
be
mean,
cheap.
so
No.
there is I don't know what the opposite of margin of safety is. Margin of, I guess, premium, I guess is probably the right word,
Mm-hmm.
but margin of story, I think is what it is. It's pretty
And
solid.
human psyche
Yeah,
and
there's a lot. Animal
mania and
spirits,
whatever you call it. Yeah.
it's a lot.
There is a premium. Sure.
There's a premium, and they have to, like, a difference between the story of Nvidia and the story of Broadcom is Nvidia, I'd say it's easier to see the story, whether or not it's believed. But if AI continues or if AI starts to really fulfill the promise that it's putting out there, and Nvidia stays the dominant player, then you go, okay, I can see the story, whether I believe that story or not. The story of Broadcom is like, I see those coattails, and I'm gonna hold on to those coattails for as long as humanly possible, and continue to run a very solid business. Like, it is a very well managed company, so I'm gonna keep doing what I'm doing. And if there's those coattails there, let me try and get into that game. But it's not like Broadcom has the chips,
Yeah. Yeah.
so we'll see. Anyway, I'm holding on, and I'm having a good time right now.
Awesome. Anything else in your fishbowl?
No, that's all I got.
Thanks, guys. Nice to be back. Appreciate you being here. Hope you enjoyed my rant, and send me listener mail on how I'm stupid. I'd love to read it. Be great. Also, if you want to send us listener mail related to the story about what you learned from your parents or investing mentors, like, I think that's fascinating stuff, and we'd love to share it on the show if you want to share with us. All things for the show are skippydoogles.com. Premium subscriptions available to help support the show, and get more details about, like, get more conversations about that, like the Broadcom conversation we just had about how we think about our personal portfolio and when we're buying things. I have another rebalance coming up here in a month or so.
Ooh.
And it's just carnage, Doogles. It's just like there's lots of good stuff to buy, and only 5 stocks that actually perform. So it's fun times for me.
Yeah.
Did I miss anything? Oh, premium subscriptions, skippydoogles.supercast.com. Listener mail, skippydoogles@gmail.com.
There we go. See you soon.
Thanks, guys.